Imagine waking up one morning to find that your savings have quietly grown overnight, all thanks to a simple yet powerful system investing in the stock market. But before we dive into the nuts and bolts of how to make this happen, let's start with a crucial question. What exactly is the stock market, and why should you care about it? The stock market isn't just a place where the rich get richer. It's a world where everyday people like you and me can take control of our financial futures. It's not as complicated or intimidating as it may seem. Picture it as a bustling marketplace. But instead of fruits and vegetables, people are buying and selling tiny pieces of companies. These are called stocks. When you own a stock, you own a small part of a company. And as that company grows and makes more money, the value of your little piece can grow too. Sounds intriguing, right? But before we proceed, please like this video and subscribe to this channel for our future updates. The origins of the stock market. The story of the stock market began centuries ago in the cobblestone streets of Amsterdam. Back in the early 1600s, merchants needed money to fund their long, risky voyages to the East Indies. Instead of borrowing from banks, they decided to offer pieces of their businesses to investors. These investors, in turn, would share in the profits when the ships returned loaded with spices and silk. This was the birth of the first official stock exchange, the Amsterdam Stock Exchange. Fast forward to today, and the concept remains the same, although it's now a lot more accessible. No longer confined to the elite, the stock market has become a vehicle for millions of people worldwide to grow their wealth. But how does one actually get started in this vast financial arena? Understanding stocks. Let's break down what a stock really is. Imagine your favorite pizza joint. Now think about this. What if the owner of that pizza joint wanted to expand but didn't have enough money to do it? They could ask you to chip in some money in exchange for a tiny share of the business. This tiny share would mean that every time the pizza joint makes a profit, you get a slice of that profit. In the stock market, that pizza joint is like any other company, and the tiny share is what we call a stock. When you buy a stock, you're buying a piece of a company. If a company does well, the value of your stock increases. If a company doesn't do so well, the value might drop. It's a simple concept, but with the potential to be incredibly powerful over time. Now, stocks come in two main types, common and preferred. Common stocks are what most people think of when they talk about stocks. They give you a share of the profits and also a vote in important company decisions. Preferred stocks, on the other hand, give you a fixed dividend, which is like getting regular interest from a savings account, but they don't usually come with voting rights. The role of the stock exchange. So where do you go to buy these stocks? Enter the stock exchange, a marketplace where stocks are bought and sold. Think of it as a giant auction house where investors place bids on shares of companies. The two most famous stock exchanges in the world are the New York Stock Exchange and the NASDAQ. The NYSE, with its iconic Wall Street address, is the oldest and most prestigious, while the NASDAQ is known for being the home of technology giants like Apple and Google. When you decide to buy a stock, you do so through a broker, either a person or an online platform. The broker sends your order to the exchange where it gets matched with a seller. Once the transaction is complete, congratulations, you're officially a shareholder. Why do stock prices go up and down? If you've ever watched the news, you've probably seen those stock tickers at the bottom of the screen, showing prices that seem to change every second. But what causes these prices to fluctuate so much? The answer lies in the simple laws of supply and demand. When more people want to buy a stock than sell it, the price goes up. When more people want to sell a stock than buy it, the price goes down. But what makes people want to buy or sell in the first place? A mix of factors including company performance, economic news, interest rates, and even investor psychology. For example, if a company announces record profits, more investors might want to buy its stock, pushing the price higher. On the flip side, if a company faces a scandal or financial trouble, more investors might sell, causing the price to drop. The power of compounding. One of the most powerful concepts in investing is compounding. This is the idea that your investment returns can generate their own returns over time. Imagine you invest $1,000 in a stock that earns a 10% return each year. At the end of the first year, you have $1,100. In the second year, you earn 10% on $1,100, giving you $1,210. Over time, this effect snowballs, turning a modest investment into a substantial nest egg. Compounding is why it's important to start investing as early as possible. The longer your money has to grow, the more powerful compounding becomes. It's like planting a tree. The sooner you plant it, the bigger it will grow. Risk and reward. No discussion of the stock market would be complete without talking about risk. Investing in stocks is not without its downsides. The market can be volatile, meaning prices can go up and down quickly. In the short term, this can be nerve-wracking, but it's important to remember that investing is a long-term game. The key is to understand your risk tolerance, how much risk you're willing to take on. If the thought of losing money keeps you up at night, you might want to stick to less risky investments like bonds. But if you're in it for the long haul and can stomach the ups and downs, stocks have historically provided higher returns than any other type of investment. Diversification. One of the best ways to manage risk is through diversification. This simply means spreading your investments across different types of assets like stocks, bonds, and real estate, so that if one investment doesn't do well, the others can help cushion the blow. In the world of stocks, diversification also means investing in a variety of companies across different industries. For example, if you only invest in tech stocks and the tech industry takes a hit, your entire portfolio could suffer. But if you also invest in healthcare, consumer goods, and energy stocks, a downturn in one industry is less likely to have a big impact on your overall portfolio. How to get started. Ready to take the plunge? Here's how to get started. First, you'll need to open a brokerage account. This is where you'll buy and sell stocks. Many online brokers today offer easy-to-use platforms with low fees, making it easier than ever to start investing. Next, you'll need to fund your account. Decide how much money you're comfortable investing. This should be money you won't need for a while, since the stock market is best suited for long-term goals. Once your account is funded, it's time to choose your stocks. Start by researching companies you're familiar with and believe have strong growth potential. Look at their financial health, industry position, and future prospects. And remember, it's okay to start small. You don't need to invest thousands of dollars right away. Even a modest investment can grow significantly over time. The importance of patience and discipline. Investing in the stock market is not a get-rich-quick scheme. It requires patience and discipline. The market will have its ups and downs, and it's easy to get caught up in the excitement or panic. But the most successful investors are those who stay the course, sticking to their long-term plan even when things get tough. One strategy that can help is dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of the stock price. Over time, this approach can reduce the impact of market volatility and help you build a substantial portfolio. Common mistakes to avoid. As you embark on your investing journey, be aware of some common mistakes. One of the biggest is trying to time the market, buying stocks when prices are low and selling when they're high. The truth is, even professional investors struggle to time the market correctly. Instead, focus on the long term and avoid the temptation to make impulsive decisions based on short-term market movements. Another mistake is investing in companies you don't understand. It's important to do your homework and invest in businesses you believe in. Don't just follow the crowd or invest based on a hot tip. The emotional side of investing. Investing is not just about numbers, it's also about emotions. Fear and greed can lead to poor decision-making, like selling during a market downturn or buying into a bubble. One way to keep your emotions in check is to have a clear investment plan and stick to it. This plan should outline your goals, risk tolerance, and strategy for achieving those goals. It's also important to keep things in perspective. The stock market has historically trended upward over the long term, despite periods of volatility. By staying focused on your long-term goals, you can avoid getting caught up in the market's day-to-day fluctuations. Understanding market indices. If you've ever heard someone say the market is up or the market is down, they're usually referring to a market index. A market index is a measurement of a section of the stock market, and it's used to give a snapshot of how the market or a specific part of it is performing. The most well-known indices in the U.S. are the Dow Jones Industrial Average (DIA), the S&P 500, and the NASDAQ Composite. The DJIA tracks 30 large, publicly owned companies, while the S&P 500 includes 500 of the largest companies in the U.S., making it a broader measure of the market. The NASDAQ Composite is heavily weighted towards technology companies, reflecting the performance of the tech sector. Investing in the stock market can seem intimidating at first, but with the right approach, it's a powerful tool for building wealth and securing your financial future. Remember, the key is to start early, stay disciplined, and keep a long-term perspective. In the end, investing is not just about making money, it's about taking control of your financial destiny, providing for your loved ones, and having the freedom to live life on your own terms. So why wait? Start your journey into the world of investing today and watch as your financial future unfolds in ways you never thought possible.